All right, Matt the Mortgage Guy here. In today's video, I'm gonna go over an amazing opportunity that I'm seeing right now from people who may have bought with down payment assistance in 2018, 2019, even 2020. With this rapid appreciation we've seen, we're able to refinance folks out, pay off the first, pay off the second and third, which come with a lot of down payment programs here in California, maybe even take cash out, remove mortgage insurance, lower your payment, pull some cash out to pay off other bills, and not have to worry about that pesky second and third loan sitting on the back end of the first. So before I get into it, if you want straightforward mortgage advice, somebody who's in it all day, every day, a mortgage broker that closes hundreds of transactions per year, talks to hundreds of clients every month, dozens of real estate agents, and just going to give you my feedback on what I'm seeing, what I'm hearing, what I'm feeling in regards to the real estate market, in regards to mortgage rates and what's going on with mortgage regulation and whatnot, please consider subscribing to the channel. Share this with a friend that might enjoy it, might benefit from it. Okay, let's jump into it. So I've been getting more and more of these scenarios lately, and I'm realizing, wow, these are good looking scenarios. These are people that can truly benefit from a refinance right now. So I turn on the camera to make a video speaking to you. If you purchased a home with down payment assistance in these last, let's call it 2 to 5 years, and you have not refinanced out of that yet, I highly encourage you to take a look. Here in California, the most popular program, Cal HFA, generally when written, comes with the first mortgage loan and then a second and a third. And that second and third loan sit on the back of your first loan. A lot of times you don't have a payment due. They just sit in, a silent second position and, might collect interest, might not. But whatever the case may be, when folks have seen the equity they've seen in the last couple years, and now a house that you bought for $360 is now worth $525, you're in a position to do a refinance, pay off the first, the second, and the third, get into a lower interest rate, remove mortgage insurance, and really set yourself up with either a nicer new mortgage with a lower mortgage payment, or, like is the case with a lot of clients I'm working with right now, paying off some consumer debt, right? And so a cash out refinance might pay off all three of those loans that were originally taken at purchase with the down payment assistance, and paying off $30,000, $40,000 in credit card debt, and still being at 80% loan to value. A nice looking new mortgage. So a couple things to take into consideration is you want to look at what the house is worth today versus what you owe in total. If you owe $372 on your first, the second is $5,700, and the third is $11,400. All those added up, whatever that balance is, plus rolling in some costs of the refinance, you just want that to be 80% or lower of the total mortgage. Granted, you could do it even if it was higher, right? Because if the second and the third were used as purchase money, you can roll all that in and pay all that off, and it's considered a rate and term refinance. It's not a cash out. But in an ideal situation, and really most parts of California, most markets across the US, if you've been in this home for 18 months or longer, you've seen 20, 25, 30% appreciation. So you're already there. So if you're sitting in a 4%, a 4.5% loan, you've got mortgage insurance, you've got a second and third hanging out on the back end, reach out to somebody like Entrust who can put together scenarios for you. One thing I'll tell you too, sometimes these loans aren't being paid on, right? And so these are balances that are slowly creeping up. Some might have like a simple interest of 3%, but even so, you don't want to get in a position. I refinanced a client last year. They had gotten down payment assistance way in the heck back in 2009 or 2010, had let this loan kind of slowly trickle up in what they owed. And all these years later, this thing had collected 18 or 22,000 interest. They owed that much more, right? And so ideally, when home values are up and rates are low, you refinance, wipe off all that first, second, and third, get yourself into one fixed rate payment, where you're paying, principal payment on a portion of the whole thing, right? Not just your first and your second and third are slowly going up, but all of the balance is coming down as you're making that monthly payment. So I won't belabor this and spend too long, lengthening this video. If you have any questions at all, please feel free to reach out to me and my team. We're happy to help. Go to greatmortgagebroker.com, fill out that quick form. Someone will be in contact within the next 24 hours and get you started with however we can help you. So greatmortgagebroker.com, find us there. Looking forward to working with you. And until next time, we gonna see.